Good afternoon, and welcome to today's episode of the Dairy Signal. Today we are joined by Ben Buckner, Chief Grains and Dairy Analyst with Ag Resource Company, who will be providing us with a market update. As always, we encourage everyone to take advantage of having Ben with us live over the next hour and submit your questions. To ask a question, click the three dots in the bottom right-hand corner of the video screen and select the Ask Question button. With that, Ben, I am going to hand it over to you.
Okay, well, thank you, Amber. Always a pleasure to be on the Dairy Signal. And so let's get into it. And I think we will start off by just kind of giving some high level advice. And what has changed in the last 2 weeks, and it's been kind of an evolving thing over the last really 45 days or so, is we're thinking about feed markets. I think that is the biggest risk to dairy operation profitability at this point. And markets look pretty good now. We can look at income over feed, milk feed ratios. They haven't done a whole lot. Um, but the milk outlook, as we'll get into, of course, get into all the details. It's not a great outlook, but pretty neutral. I think equilibrium here, but it's margins that are at risk. And so I think there is smoke, if not fire, when we think about a potential bull market in the grains. Certain dominoes will have to fall, but I think from a very high level, there's just going to be fewer bushels of everything in 2026. So that's different than it was a year ago. We'll even kind of talk about the nuance of sentiment and how that differs this year to last year. And so it looks like it's changing. And I think that the very high level message is there's just not a lot of room, or will be a lot of room for tolerance for weather adversity, whether that's the U.S. through the rest of this growing season, South America next year, or the Northern Hemisphere 1 year from now. Things are tightening. Milk feed ratios are pretty good. I think we're kind of recommending to a lot of people to buy feed. And we'll leave it to you how long you want to cover, but we do like the end of the calendar year. And so I'll kind of spend the next tens of minutes explaining why that is the case. So fortunately, as we get into this kind of non-robust milk price outlook through the month of May, we have seen pretty decent cash prices, nationally. 21.30 on average, all milk, 19.50 in Wisconsin. And I think that is partially that some of these, stellar performing markets, at least to that point, like whey and non-fat dry, record non-fat dry prices, very elevated whey prices, and still at least through the end of May, we just can't produce enough, high protein whey concentrate to meet demand. So those stocks have been very, very tight. And so that's kept this, what's been like a $3 to $4 premium in the cash milk market over class three. I do think that changes. So just want to prepare everyone for this. And still, like we've talked about for many dairy signals in a row, recoveries in milk are places to kind of offset risk when we think about the rest of 26, and especially Q1. $17.50 Jan Fed class three, I think has a lot of value in it. But I do think the cash milk markets will be evolving kind of to the downside, and that's really just based on kind of eroding powder prices, if nothing else. We've got a very boring cheese market, a very boring butter market, all things considered. And so I think that calculation does change. So we're looking at something like, June when that data is out, and into September, cash prices, all milk, something like 1930 to 1990. Will vary, by a few dimes given what state you're in. But I think that is kind of the new lower plateau we're looking at for the rest of the calendar year. Still not a bad price. Again, still not bad milk feed ratios, but we like locking in what exists today. And it wasn't really a surprise. Non-fat dry was a very tight market, couldn't produce enough demand, pretty incredible, in the domestic and even occasionally in the export sector. But when you do see markets like this, you know that they're very exciting, but maybe not necessarily healthy. And so that cash non-fat dry that shows us the central region has dropped about 60 cents per pound, is aligned with previous bull markets that look very similar. And it's still a very, very high price, but I do think the market's worked to encourage production, of course, but also slow enough demand on the margin that we are building non-fat dry stock. So when you get markets that are, no matter what it is, crude oil, corn, meat, any dairy product, when those markets are not well supplied, supplies are tight, prices are high, kind of on the side, you've got incredible volatility. So there are no small moves in markets like that. And that's what we've seen in non-fat dry. But wanted to point out that it's moving lower, it's not moving higher, because the market at, this price series at $2.40 per pound, started to accomplish a lot of the goals that needed to be accomplished: building stocks, reducing demand, encouraging production. So I imagine we do probably drift lower in the powder market for the rest of 2026. So just thinking about cash milk calculations, we'll be drifting lower. So that's kind of the story there. Otherwise, I think something that's come out, and this is, we addressed this 2 weeks ago, is just kind of equilibrium prices. There's really not much to be overly bearish about at $16 spot class 3 for now, and not much to be bullish at above 17 or 17 and a half. So we're producing lots of milk. Well, of course, we're going to show those charts again in the US, Europe, globally. We're also making a lot of it disappear. So whether that's through these kind of ad hoc trade deals that have been established with the US, or I think just very competitive US prices. And as we debate sort of the nuance of demand growth for protein and fat, is it a very sizable 3%, or is it 1.5%? Still very, very strong. So there is room for US dairy to find homes in foreign markets. And that's what we've seen. This data is delayed. It only gets us through the end of May, but it's just been pretty incredible. Another 260,000 tons of all dairy products shipped in May, included 35,000 tons to China. They've just never really left the market. And I think China, as we, go through tension and nod and debate trade deals that have or have not been established, China is, a very good trader. And so they're just buying the cheapest dairy products in the world. And those have been US origin for a lot of the time. So export demand is certainly providing an outlet for this incredible amount of milk that's being produced still. I think we kind of think about these trade deals. It's been South Korea, Mexico, Canada to date have been the largest buyers, Philippines, but we haven't seen, physical copies of any trade deals that have been released by the White House. But we do know that people are more friendly with the US now. So even if it's just, the Philippines, Indonesia, South Korea, kind of sourcing the entirety of their dairy or corn needs with US supplies to stay in the good graces of the United States, I think we have seen that impact things like corn exports, cheese exports, maybe even to some extent wheat exports, but certainly in the dairy space. Fluid milk and cream exports, and nearly an all-time record 16.5 million liters. So this is kind of showing us that, the price of any of these products will be determined by supply and demand. And it doesn't have to be higher than it is today, but weak prices are finding consumption growth. So those are attractive prices, and that still continues and I think stays in place through the rest of summer. It's the domestic cheese market that we are concerned about. This is not really insightful to the marketplace. We can all see what cheese and class 3 prices have done. And it was just another month that we can put the pieces of the puzzle together. So American cheese production in May was down 3% from the previous year. So we knew that a couple of weeks ago. Exports are very good. But then we get stocks of cheese at the end of May up 1% at 817 million pounds. So then you kind of fill in the hole. 499 million pounds of American cheese were made to disappear in May. And like March and April, that's down, 5, 6, 7 million pounds from the previous year. And so we're at a very high level of cheese consumption, but unlike butter, it's been challenging to make this number go up. And the reason that I'm highlighting this is, to balance, the fat-based side of the US milk balance sheet. And we get these numbers every month. Domestic use across the board has to be up, 1 or 2%. It's happening in butter, but it's not happening in cheese. So the cheese market, if we think about, let's assign some kind of human characteristics to the market and think about it from a very, very big picture. It's got to encourage domestic consumption growth. And so how that happens, of course, is price. We know that, but think about how class 3 and cheese prices will be determined for the next 6 months. And then there will be occasional recoveries. Those could be very exciting, but just think in the back of your mind that, Ag Resources, showing us that the goal of cheese is to find domestic consumption growth above and beyond what's happening currently. That only happens with reasonable prices. We still need to compete for export demand to clear inventories. And so that's just kind of an anchor on the whole space for the rest of 2026, at least. That, though, is still king. If we did this 2 months ago, we were concerned that also butter consumption domestically was not growing. for building stocks. There's a lot of butter on Earth. This was all very, very bad. But since then, I think we found maybe this is just warming temperatures, more people eating outside, maybe the cooling of crude oil prices as well. So more money being spent at restaurants. That's something we've noticed the last couple of months. Growth is back. So, 25 million pounds of butter consumption above last year. So we're probably looking at record butter disappearance. So the market at, today it's $1.65 per pound in the cash market. Doesn't have to go up, but I think it can't go down from here because that market is finding adequate consumption growth at those prices. But also lingering in the background, again, this is kind of a long-winded way of saying the milk market's still at equilibrium. No threat to short-term U.S. milk production and global milk production. So one of the I guess, surprises, but this is still, I think, rooted in beef prices, the need for elevated beef production, because all of these cow numbers, the real growth, and it is happening in Wisconsin, but the real growth is in Kansas, Texas, and the Dakotas, so kind of the spine of the central U.S., large beef producing regions. But anyway, the record cow numbers has grown every month for the last 3 months, 9.67 million head. I don't think this number changes materially in the next 3 to 6 months. So if we just apply what has been proven to be average per cow output growth, and that can range from 0.2% to 0.5%. You're kind of locked into milk production growth indefinitely. So that is kind of the message here, is that we can all see and feel this. This has been the case, every month the milk production report comes out. It's usually larger than expected. The previous month's number was revised upward, et cetera. There's no shortage of milk. Milk is abundant. But I think it's the absence, for the most part, that this trend changes for the next 6 months. And we can't really identify where that's happening. And we will talk about France and temperatures there in just a bit. But elsewhere, it seems like if we kind of start the process looking at cow numbers and weather, for example, the U.S. doesn't have any glaring issues today, I don't think. We're in this incredible El Nino event, which typically produces really rapid, incredible droughts in Australia. That's not happened yet. And Europe, most of Europe doing fine weather-wise and with at least feed supplies for the summer months. So I don't think that there is enough of a catalyst to all of a sudden drop European or New Zealand milk production, at least for the next 90 days. So I think that when we do this meeting in 3 months, these bars will stay above zero as of September and October. And that's important. We've talked about this before. At the very, very core, this shows you whether you're in a bull or a bear market. And we need to see contraction of supplies to be a bull market. Also, what is new this week in the dairy markets is we have got a new auction and global auction results, and those were surprisingly weak for cheese. So the auction's average cheddar price was $1.77 per pound. That is the lowest since 2024 and down about 20 cents from 2 months ago. U.S. cheese is still very competitive, but I think when we think about this and think big picture, kind of like cheeses need to find domestic consumption growth, whatever this price is, whether it's the auction or physical cheese prices in Europe, for example, that's kind of your cap on recoveries. So I do think something like $1.80 cheese would be very upside potential for the rest of 2026. That very basically is about $18 class 3 milk. And so, and again, wanted to communicate that we can't identify a way this changes in the next several months. So when we do see recoveries, class 3 in cheese, we got to know what to do with them. The strategy is still uncomplicated. The butter market's been slower to retract globally, but still kind of gives you what is upside potential in the U.S. market, kind of worst case scenarios domestically. And this is the butter price here is really centered on the Oceania market. I would say that the European butter market's dropped to $2 per pound. So that's kind of your upside, I think, in the U.S. cash butter market. Certainly above current prices, but to what extent is the big question here. But what I wanted to talk about this week, again, it's this kind of smoke building around the potential bull market in feed prices and U.S. grain and soybean prices in particular. So here we've got just a very basic class 3 milk to corn ratio and soybean meal. And they're not the best they've ever been, but they're certainly not the worst they've ever been, and kind of right at the longer term averages. And like we started out, I think these are margins to lock in. And again, we'd rather be wrong on that side of the ledger than the opposite, I think is the message. And so getting right into it without burying the lead, this is how we think the US corn balance sheet evolves, not in the next, not tomorrow, not in August, but we think by the winter months and in the second half of the corn marketing year. So we've got a lot of new data, stocks as of June 1st, what will be, for the most part, pretty close to final US planted acreage. They did not really cut US corn acreage at all. That was somewhat of a surprise. They did confirm that feed and residual use for one way or another, maybe it's last year's crop was overstated, or we're feeding animals to heavier weights, whatever it is a record. And so we just know this is just basic arithmetic. We kind of know what the USDA is going to do tomorrow. They have to raise feed use by 50 or 100 million bushels, old crop. We also know that based on the pace of export sales and shipments, they probably have to raise that number by 50 million bushels, maybe 100. So all of a sudden, in 30 days' time, we're going to go from US corn into stocks as old crop, from about 2.1 billion bushels to 1.95 or so. And that's not dramatic. Corn's 450 for a reason. But we're carrying over almost 200 million bushels less into 26 balance sheet. I will not be married to any yield really ever until the January crop report, but we've kind of opted to kind of trim the range to maybe 181 or 183. And just kind of regional challenges, and we'll talk about weather in just a bit, but just not the same year that it was a year ago. Because of China and their commitment to buy $17 billion of non-soybean ag goods. And really just because of these kind of ad hoc trade deals, US corn is kind of surprisingly competitive for the next 6 months. Brazilian corn is more expensive. Corn in Ukraine is more expensive. I think we've got to keep exports unchanged in 26, 27. So we're not having much demand contraction. There will be fewer bushels of grain just because we're planting less of it. So I think that is the very highest level message. And so if yield is 181, then ending stocks, and this is because you can't change consumption, drops to about 1.3 billion bushels. It's a very different market, 4 and 6 months from now than we've seen the last 2 years. And again, not being married to any yield, we are just keeping intact sort of scenario. So let us say that weather is absolutely perfect for the next 60 days, and we do yield 186. I think what is interesting is still doing this math, you're left with 1.7 billion bushels. That is still down, a little over 200 million bushels from the current year. So there's really no scenario, I think, maybe not no scenario, but very few scenarios in that we'll have more corn next year than this year. And again, that's kind of the beginning and end, I think, of the feed outlook. Fewer bushels, higher highs, and higher lows for the next, probably 9 or 10 months. And it also kind of shows us that while the market will be hyper-focused, probably, beyond what happens between the US and China, or the US and Spain, for example, probably just Midwest weather. And I don't know what yield will be. I don't know even what weather will be, 10 or 12 days from now. But I think it just, the bearish case now is just kind of rooted or centered on US yield. So weather has got to be very good to pressure the market, after the next 10 days or 2 weeks. And I can't prove that we won't yield 186, but odds of that I think are lower this year than last. And soybeans just going to be very, very tight, very valuable. It's going to be hard to grow supplies of this. And I think this is also just very simply centered on the USDA's new crop, what will be close to final acres. So it was up about, 700,000 acres from their estimate in March, but I think the market kind of expected maybe like 1.5 million or 2 million. It didn't get that. So assuming yield between 52.5 or 53.5, kind of the best we can do within stocks is 340 million bushels, which is about where we are this year. So the market, again, I think the best case scenario for the bear case is just kind of we repeat what happened in the last 12 months. So, $12.50, $13 after summer is very much in play because a lot of this stuff can't be changed. We're going to crush, record amounts, 2.8 billion bushels. That is what we think capacity is, and the USDA. We're going to maximize capacity to meet biofuel policy. Exports, we've got here at 1.7 billion bushels. That is just kind of assuming China comes back something close to normality. Not like last year, but kind of all years before that, just buying U.S. soybeans if they are competitive. And we're kind of seeing that happen September, October. So this does not require a whole lot of export demand growth to get the soybean balance sheet very tight. And again, the market's trading, adequate supplies today. We're still probably harvesting a few fields of soybeans in Argentina. Supplies are not going to be short for the next 3 months, but the back half of the crop year, I think, is when do you play this game of musical chairs and that the dairy operation competes with China, South Korea, ethanol plants, soybean crush plants to sort of grab what's available? And that was not the case a year ago when we're just kind of every single week and month raising total supplies because of weather somewhere, government data in some country. Kind of the opposite is true today. What we're looking at here is weather, and I think weather to me is I don't know, and it depends where you are and where your farm is, but I'd say overall, from a market perspective, seasonal yield potential, it's fine. It's not great, but I think we're avoiding, the worst of the worst. Even the temperature forecast, Chicago was supposed to be 97 degrees this weekend. Now it's 85. So it's kind of mild-ish. Rains a lot in some places. Some areas are dry, but this is kind of an unremarkable growing season to me. But it's different than it was a year ago. So talking about kind of starting this off, the sentiment, it was about this week where you had these incredibly high rated corn and soybean crops. And as you got closer to kind of crop tour season in early August, everyone's unsure of what to expect in that. Would they find national corn yield potential of 185, or would it be 190 or 192? It seemed like everyone knew, outside of the arrival of rust to Iowa, this is a pretty special growing season in 2025. This is a pretty average growing season. So again, thinking about, we lost corn acres, almost 3 million. Weather's okay. It's not great. We're just kind of guaranteed to lose bushels of this stuff. So again, we don't want to overcomplicate this. That is, again, the core of this outlook. And we do have some stress, the next 5 days on the left, temperatures in the 80s. This is pretty good. This forecast has gotten cooler. But I do think we're on track for some, mid 90s next week. Does that last? Uncertain today, probably not. But you're going to have net soil moisture loss in places like South Dakota, Kansas, Nebraska. We didn't see that a year ago. In fact, sort of the biggest or best yield performance on the margin was in places like Kansas and Nebraska. Kind of an unusual year there. This is what I mean when I say that crop ratings, which can only get you within 3 or 4 bushels of yield at this point in terms of your models, just kind of middling. That's fine. It's 67% good to excellent. It's been higher. It's been lower. Not particularly special. You can see where things are doing the best. And clearly it is Wisconsin and neighboring areas where you've got very, very highly rated crops. But everyone else doing okay, but down pretty substantially from a year ago in places like Illinois, for example. 58% good to excellent. That's only a decent crop we're working with here. And so again, it's just kind of hard to build supplies. And the market's idea is not like it was a year ago in that how high is high in terms of yield potential. It's more like where does it fall within 1% of trend. And that's, I think, as excited as we can get. But that's not really the core issue here. Even us lowering corn yield from 183 to 181 bushels an acre as a fractional change. That means very little, but it's the story that we'll tell now is it's being added to a lot of issues we've seen so far. So you have probably seen in any media outlet, discussions about temperatures and what is now historic drought in France, Spain, even parts of the United Kingdom. It doesn't look like there's any relief in sight for the next 10 days. And kind of see how uniquely bad this is when we plot, rainfall in June and July in France. And so this assumes that the 2-week forecast is correct, but we're looking at only best case scenario, 2 inches of rain in the 60 days. That's the heart of the growing season. And normally it's about 4.2 inches. So we're at about half of that. This has been sort of accelerated by just incredible temperatures. I mean, we did this, I think, 2 weeks ago, and we're doing it again, where almost every day, especially the southwest part of France, where it's the hottest, that's also where the most corn is produced. pretty significant sustained temperatures, 101, 102 degrees. This is the last 2 days, the maximum temperature. And while like France and the European Union, not the biggest producer of anything or largest exporter, I think this is going to materially disrupt global grain flows. So, unfortunately for the European feed balance sheet, this is all kind of centered on France. France is by far the largest producer of everything in the European Union, from milk to corn, wheat, oilseeds. It's France that's the largest. And they only produce 500 million bushels of corn, but that 500 million bushels of corn is very valuable to everyone else in Europe. France is kind of the supplier to people that are not, or countries that are not self-sustaining. I don't think that they'll be able to do that this year. This is kind of like 2012 when you can throw out yield estimates down 40, 45% from last year. It sounds crazy, but I think all of that is in play given how hot and dry it's been. So you think longer term, and what we've seen really as the European corn balance sheet has tightened, you do have the countries really closest to the United States, that being Portugal, Spain, and Ireland, starting to buy U.S. corn. There's really there's no longer any GMO restrictions there. So if they can source it logistically cheaper from the U.S., they will do that, and they have been doing that. The European Union used to buy, prior to last year, maybe it was 2 or 20 million bushels of U.S. corn. In the 25-26 year, I think it will be 180 million bushels. And I think if we can sort out or avoid real tension with Spain, that number gets to 200 million bushels in 26-27. So again, just kind of math, we have lowered yield, about 5-7%. Europe's going to have to import a record 25 million tons of corn to meet feed demand. And I think 5, maybe 7 million tons of that will come from the U.S. So this is kind of added to, middling U.S. crop ratings. We've already lost substantial wheat acres in production. And so similar to the U.S. balance sheet, I think kind of the beginning and end of the corn and feed market outlook is just having fewer bushels, fewer tons. So adding some modest U.S. losses in production to what's happening in Western Europe, we kind of come up with a global corn supply number that's down 32 million tons from last year, or about 1.3 billion bushels. That can't really be made up until 2027. So smaller crop, higher prices. We're also kind of raising the discrepancy between supply and demand. And all this, again, is just kind of rooted in less than ideal U.S. growing conditions, drought in France, and that's all it's taken to get production 23 million tons short of consumption. This is a big deal. I think this kind of changes structures of markets. And then when we take our U.S. balance sheet adjustments for corn and just plug them into the exporter balance sheet, you can see things change pretty dramatically. And so corn and wheat both, pretty clearly oversupplied a year ago. The market's trying to clear excess stocks. We had harvest lows a year ago. I think it's $3.80 per bushel, slow to recover. This explains why. There was just a lot of corn in an exportable position. But because of higher European import needs, lower U.S. production, which weather aside, just kind of centered on lower U.S. acres, exporter stocks to use drops to 8.1%, and we lose about 12 million tons of export stocks. And this assumes weather normalcy in South America, this winter and next spring. So we can't adjust any of that yet, but it just gets very tight. And so if nothing else, this doesn't give you precise price targets. This number will be fluid. This is just what it looks like today, but it kind of tells you we can't really deal with weather issues above and beyond what we've already seen. So there's going to be an incredible amount of focus and a pretty high burden placed upon South American weather and yield performance 26 and 2027. So here's where we are. It just looks different. So the oversupply of a year ago, kind of forgotten completely. It's been fixed or sorted out in just one crop year. And wheat too, and just thinking about grains as a whole. And again, this is not really even Ag Resource Insight. We've just adjusted the U.S. wheat balance sheet in 26-27 to account for what NASS told us final carryover stocks would be and what acres are. And so all of a sudden, what we got 2 weeks ago from the stocks and seedings data, you just had to drop U.S. wheat supplies another 50 million bushels. So I think tomorrow the USDA will print U.S. wheat in stocks. about 700 million bushels or less. And so incredible oversupply of wheat 1 year ago. Weather was perfect everywhere. We had too much. We saw wheat with a 4 in front of it for a few days in the last 12 months. It's been fixed and wiped out completely in one crop year. And so whether it's reduced plantings in the U.S., drought in the hard red wheat belt, lower spring wheat planting in Russia, now we're trimming yield potential in Western Europe because of drought. And also, I think what jumped out to me most when we think about wheat or grains as a whole was, so we have all this information, the balance sheet's getting tighter and tighter every week, which is the opposite of last year. Stats Canada came out on June 30th and also lowered its wheat acreage forecast in Canada by about 1 million acres. And so it was literally the opposite. All of these countries, we were raising wheat supplies and production a year ago. This year, almost every single exporter will be losing production from initial forecasts. So all of a sudden, the combined exporters will produce 2 billion bushels less wheat than last year. And so 437 million tons, 2025, that was too much, but that was 1 year, and we were back to a tightening balance sheet. That oversupply completely wiped out, and by a small margin, this will be the smallest exported wheat crop since 2019. And again, this will be fluid. We'll have to sort of monitor trade flows, look at demand everywhere, but this is what the exporter wheat balance sheet looks like, at least today. So what jumps out is this is the tightest exported wheat balance sheet since 2007. That was a record low. This does not foreshadow wheat at $8 per bushel necessarily, but I think when you go back in history, this does suggest that Chicago wheat, which is at about $6 this afternoon, is at the very low end of fair value. So putting this all together, it's just very hard for us to identify new bearish input outside of the U.S. kind of lacking major weather threats. And it being July, rallies are hard to sustain. But again, thinking about the back half of the crop year, it kind of changes from large supplies today towards end users kind of scrambling to grab everything that does exist. Because after summer, really can't produce anything until Southern Hemisphere harvest start, February, March of the following year. And kind of finally in corn, thinking about the forward market. So usually the last couple of years, we have not paid a lot of attention to even seasonal trends of physical corn prices in South America because we've got U.S. weather to focus on. And it was very good. So a year ago, the Brazilian wholesale corn market also bottomed in July, but we didn't care because we thought corn yield might be 190 per bushel. Ultimately, from the USDA, it was 186.5. This year, we don't have those offsetting inputs. So I wanted to point out that, like normally, our biggest competitor for exports, that cash market is bottoming. Granted, today it's at $3.35 per bushel, but I think like every year, you're kind of on your way towards 70, 80 cent per bushel recoveries. That happens after July all the time. So again, what is the story if you're to be bearish of feed prices other than kind of ideal U.S. weather, which could be the case? I can't say that wheat could lose another 15, 20 cents per bushel, corn 10 or 15 cents. That would all be completely reasonable. But when we think about seasonal trends, we know that July is usually pretty weak. So is June, but that's also every year the time of year to buy. It is a buyer's market today still, and a lot of things from protein meal to corn to wheat as well, maybe even fertilizers. And these things are just valuable. So whether you go through end user margins really of any kind. So it's going to start at the top. U.S. corn is not expensive when compared to Brazilian origin or Ukrainian origin. So I think the importers will still kind of come to the U.S. for what they need to some extent, especially those countries nearby, Mexico, Latin America, West Africa. They're probably saving money buying U.S. corn still. Ethanol margins are very good, especially when accounting for 45Z credits. I think we're still pretty considerably above all costs when we look at a plant in Western Iowa. And that's not typical. There is room for the domestic market to pay more for corn than it's paying today. And that's, I think, important to acknowledge. Soybeans especially. We have seen a correction, from $5 per bushel crush margins down to about $3.40 in central Illinois. And of course, I don't think you could sustain $5 crush margins. The market will sort itself out at that point, but these are still historically high for the month of July. And so something we have brought up before, as China has confirmed that they're starting dabbling with this new crop program in the United States, probably having secured something like 750,000 tons of US soybeans. Normally, they start buying US soybeans in bulk in August. So I think that is forthcoming. US soybeans are not uncompetitive with South America after August. Unlike last year, when you had really good weather, U.S.-China trade war, China not buying kind of a single bushel of U.S. soybeans during the summer, to now there is competition for this finite supply of soybeans. The crusher is making an incredible amount of money. China will buy U.S. soybeans if for no other reason, political purposes. And so who gets left short of supply may be the issue if weather is not ideal. So think about that, given that soybeans tend to set their annual low by September. Again, it's kind of a buyer's market, and it's competition for existing bushels that defines things. At some point, maybe it's September 1st, October 1st. Like everything else in the feed space, I think it just looks very different than it looks today. Kind of lastly, we've got and so we've highlighted this before, this incredible El Nino event. So we've got the short-term history and forecast and the long-term history and forecast on the right. We were just unsure what, Pacific Ocean temperatures 3 degrees Celsius above normal due to weather patterns. I mean, so far it's been surprising and interesting. It's not producing drought in Australia. Australia has been a lot wetter than normal, but it is fanning this kind of abnormal heat in the US. That's abnormal for El Nino years. We've seen some pretty devastating rain events in parts of the US. And so this is all, I think, part and parcel of this incredible ocean temperature warmth. And so not that this leans negative for yield potential in South America or bad for August weather in the United States. I think it's just more so than ever, we are unsure what this means. So I think we want to think about this, being prepared for kind of abnormal conditions when we get to South America, US autumn, maybe even Australia in October, November. Is it too much rain that's the issue? Or does drought develop very quickly in Oceania and Southeast Asia like it normally does in El Nino years? But all that aside, assuming normal weather outside of the US and even inside the US, we kind of have this rapid contraction in feedstocks. And it gets very, very spicy if there is another weather problem somewhere else. And so I think that is where kind of the burden lies. And so to us, again, it's kind of an easy decision to start locking in feed prices where they sit today, because I don't think, even if weather were perfect, these markets do tend to bottom by August. And so that's still 30 days away, but it's only 30 days away. So kind of scaling into things makes pretty good sense to us. So that is where we will leave it for this signal, but the very high level message is, again, of course, I think dairy milk prices are pretty neutral. There's a lot of the stuff. That's not the risk to operations. The risk is, I think, over time, feed costs. And so we can manage that today, and let's get some of that stuff done. So as always, questions, rebuttals, complaints, welcome now or at any time in the future. Here is my contact information. So thank you so much for your time.
Perfect. Thank you, Ben. So you covered a lot of information today. What are a couple key messages that you want our viewers to take home with them?
Yeah, I think it's kind of the same thing. It's just there are going to be a lot fewer bushels that can be used for the feed market in 2026. I don't think we can change that. It's going to have to be the 2027 crop year when you start building surplus as a feed. And so the contraction happens, that is guaranteed. The degree of this contraction still, of course, will be determined by weather patterns, but I think there's a lot there upside in corn, for example. Is it 30 cents or is it $1? That's up to Mother Nature, but I do think that kind of locked into higher cost of things moving forward. So that's margin management is the game from now until the end of Q1 2027.
Perfect. Thank you, Ben. We did have a question come in, and it reads, what shouldn't the U.S. do which would negatively hurt U.S. dairy exports?
What shouldn't the U.S. do? I don't think that there's anything in play that we could do, it's supply. So I think we are dominating exports because we've got a lot of the stuff and it's competitive. So I think just like controlling um, supplies or somehow, artificially deflating the beef market, I think would be kind of the worst thing for the dairy farmer because man, at some point down the road, you've got fewer supplies, lower beef prices, and we're not exporting enough of the stuff. So, supply controls, of course, would be the worst. But barring that, and I don't think that's on the horizon. I think we're pretty well set to export a lot of our stuff indefinitely.
Alrighty. Well, thank you, Ben, and thank you everyone at Egg Resource Company for their continued support of the Dairy Signal. Have a great weekend, and we will see you next week here on the Signal. Bye now.